anybody wants to believe that the pharma industry is somehow funding R&D, I'm going to unfortunately surprise you with the statistic that the increased cost in pharmaceuticals is directly correlated not to M&A expenditure from an R&D standpoint, but it is actually linked to the cost of capital in venture capital. That's why the statistic that I have under acquisition exits is so important. The cost of buying R&D in the form of patents from private equity funded entities is a 40% cost of capital. 40% cost of capital. There is no more expensive capital on the planet. And so what we have done, in fact, is we've built a system which is lining the pockets of investment bankers and the merger and acquisition merchant banks. We have not created a system where the benefit is flowing to the SMEs. And don't begin to believe anybody who tells you otherwise, because unfortunately, the money is not lying here. And that is a log scale, not a linear scale. Where's the money going? Well, the money is going into drugs and medical, chemical, electronic, mechanical, computers, and biotech. That's where the largest money is growing. Interestingly enough, if you look at the money flow, however, you find a very interesting statistic. The more money flows into a sector, and the more the money goes from VC to M&A to hedge fund, you actually find out that the money becomes stupider. That's actually not really an English word, but you know what I mean. And by that I mean that weaker patents get exposed to greater litigation because more is riding on it, not from the enterprise value, but from the transactional frictional value. In other words, as you see the unlitigated patent weakness going up over time, and this work I have to credit Dr. Sarah Boninger at UC Berkeley, as you see the weakness of patents go up, you see the number of litigations of weaker patents also go up. In other words, the more dumb money is going into dumb deals, the more people fight to defend their own stupidity. That's the so what. And that's a pretty important so what. Now, I'm going to walk you through this slide because this is actually extremely vital for you to understand. And let me take a step back just for a moment to explain a very important piece of information. In 1980, in the United States, and in 1983 in Europe, both the US government and the European Commission suggested that building an SME infrastructure was going to be good for the economy. I'm going to show you the empirical proof of 20 years that actually says that's not been the case. And here's the empirical proof. If you look at what happens in large-scale procurements, and this happens on both sides of the Atlantic, prime contractors increasingly have taken on the role of efficient consolidators of SMEs. Because the governments want to deal in large tranches of capital and large contract vehicles, they actually typically award or find themselves awarded large-scale contracts. Unfortunately, the large enterprises that are awarded the contracts actually don't have the technology. And so post-award, they actually acquire the small firms that actually do the delivery of the technology. In the same case for pharma, left and right now. The problem is that the return on investment for a private equity-based SME is a 40% return cost of capital. And typically the transaction fees for M&A is about 15% when all M&A fees are included. Therefore, you have approximately 55% of the aggregate cost of capital that's not flowing to the enterprise, and it's not flowing to the ultimate consumer. It's actually getting caught up in the transactional friction of an M&A-based paradigm. And by the way, for those of you who are in the EU Parliament, you should take special note of this. Your contracting rules and your public policy don't match. Your contracting rules say that you award more contracts to large enterprises, which encourages more and more of this kind of consumption. But the bad news is you say you're pro-SME. No, you're not. You're pro-investment bank. That's what you are. Because look at what actually happens. If you actually look at the effective procurement over the last 20 years, the effective procurement, and this goes on the US and European side, and this comes from 20 years of government procurement data from both sides of the Atlantic, the the effective technology procurement value is for every dollar spent by a government, only 35 cents actually flowed to the technology provider. Which means we're doing worse than private equity markets. That's what that means. Now, we want to talk about cost-benefit analysis of patents. This statistic is how we're starting to reform the patent system. Because it turns out that the insurance industry and the capital markets are extremely telling when it comes to this type of activity. The IPR paradigm has led to what I refer to as the R&D derivative dream, which essentially says that I get a bunch of patents that increase my optionality, increase the frictional cost associated with the optionality, and ultimately what I'm trying to do is build a financial inefficiency in a system which will allow me to extract value. Now, I realize that I have a habit of putting a whole lot of information into a very short period of time and then not giving you the so what. So I'm going to give you the so what. Probably the most important thing I can tell you is patent reform is going to happen, and for those of you who wonder if it's going to be more of the same, more of the same, more of the same, the answer is no. And I can't help but acknowledge Dominique for putting one of the most visionary pieces of his slide up, but unfortunately he left it for me to actually explain why he put it up. On his second to last slide you saw the term Basel II. Now Basel II is a very esoteric issue and most of us don't pay much attention to Basel II, but we will. And on January 1st, 2008 we're going to pay a lot of attention to Basel II. It turns out that banks, and by that I mean people like Deutsche Bank, Credit Suisse, UBS, HSBC and others, have been incentivized by a number of reasons to actually issue credit to SMEs that primarily have intangible asset backing. The problem is, under Basel II, banks have to record the quality of the underlying collateral that they hold. And regrettably, Basel II is silent on how to report the quality of intellectual property and intangible asset-backed credit, which has led to a crisis in the banking system. As a matter of fact, the crisis has become extremely sensitive because of the recent derivative market crashes in the traditional property markets. For those of you not familiar with what I'm talking about, that's what I'm referring to with respect to the collateralized mortgage obligation problem, which is happening in the subprime markets, not only in the United States, but also in the UK. Now, it turns out that on January 1st, 2008, banks have to actually deal with reporting adequacy of collateral for all of the credits that they have. The penalty for not doing it is 125% risk allocation of new capital. Just to put that number into perspective, there's no bank currently on the planet that actually can keep its A rating if that were to happen. None. So we have this giant conundrum of we don't have the data, we don't understand the research, we don't understand the economic consequence of intellectual property. However, we're going to have an incentive to understand it. And the incentive is the illiquidity of our banking system. Now you came here to talk about patents, and you came here to talk about patent quality, and you came here to talk about patent economics. I'm here to tell you that the day has come when we actually have to pay the piper. And what we have to do is we have to agree that we can't keep arguing these wonderful esoteric feel-good arguments about whether patents are good or bad. Because at the end of the day, it doesn't matter. When capital sources dry up, not in the SME market, but in all the markets, because credit costs go up by 125%, I can assure you that the incentive to talk about reform is changing remarkably. It's changing in some very dramatic fashions. And if you don't believe me, ask why it was that as an economist, I was the only economist to talk about the collateralized mortgage obligation failure of the economy before it happened. And then ask yourself, might I be onto something with this whole Basel II thing? I would suggest that rather than talking about the reform of the patent system and optimizing the patent system, we actually talk about the accountability for the innovation system writ large. And we talk about the fact that we need to do a better job of understanding the economic consequence for a system which is out of control. Thank you.
Thank you, David. I'm going to have to get my head around that, but the Grim Reaper comet, is that the... Okay.